This is On the Market, a Bigger Pockets podcast presented by Fundrise. Hey everyone, welcome to On the Market. I'm your host, Dave Meyer, and I am joined today by James Daynard. James, what's going on, man?
Just grinding out deals, Pacific Northwest, trying to get more inventory in the door.
How's that going? You pretty active right now?
Yeah, we are staying fairly active right now. You know, what we've been doing is kind of fixing all of our systems, pivoting all our systems, and we're wrapping up all the inventory we bought over the last year. And then we've been aggressively, actually, we gotten contracted over $16 million in deals the last 4 weeks. I just closed on 2 fix and flips, and they're all sizes. Fix and flip, small guys, one big one, I paid $400 for, one 1.5 for. I just got a duplex for 1.1, and then we locked in a pretty big deal for little above 10 mil. So moving things along.
That's awesome, man. Well, keep it up. That's great to hear. Today for the show, we have Ben Miller, who is the CEO of Fundrise. And full disclosure, Fundrise is a financial sponsor of this show. But Ben is an incredible wealth of knowledge. It was so fun having him on. He's kind of like, I feel like you guys have a lot in common. You're both deal junkies and just love talking shop about like individual real estate deals and strategies. What did you take away from the interview that you think the audience should listen for?
Well, he definitely is a deal guy, which is always good to invest in a deal guy. Because when I said I stayed at the office till midnight, his eyes perked up. He's like, "Yes, I get you."
He's gonna make you a job offer after this interview.
Hopefully not. I don't know if I can take on any more, but it was just nice talking because we, as small investors, we go toe to toe with some of these big guys, and just to see where their strategy is and how they've kind of pivoted out and are doing things. I was really excited to hear about their efficiencies and how they kind of basically they make the return by being efficient, and that's the kind of product they're looking for. They're not just looking for the best deal and what fits inside the box. And that's so key in today's market right now. As the market flattens out, you have to be really good at what you're going to do to hit your return. And that's the same with these big guys. The small guys are no bigger than the big guys. They're doing the exact same thing. How can they be efficient? How can they deploy the money and deploy it in the right area?
Yeah, absolutely. And Ben, in addition to talking about these efficiencies, gives some really good advice about what markets he's investing in, a whole new asset class in buy to rent. We had a really good conversation about that I was super interested in, and just shares his thoughts on where the market's going over the next couple of years. So definitely stick around for this interview with Ben, and we're going to invite him on in just a minute. But first, we're going to take a short break. Ben Miller, CEO of Fundrise. Welcome to On the Market.
Hey, thanks for having me.
Thanks for being here. We're super excited to have you. Before we get into some of the market conditions and what's going on in your business, would love to just hear a little bit about your background and how you got started in real estate investing.
All right. Well, so I've been in this business about 23 years. So I started out in real estate private equity and then moved to the real estate development sponsorship side. So worked for a large mixed-use development company in DC. We were building about $500 million of real estate right when 2008 financial crisis hit. And so I have like scars and like burn wounds from that experience. And after that, I came out of it thinking, well, there's got to be a better way, and conceived of the idea of raising capital through the internet for real estate. And we essentially invented that concept in 2012, and Fundrise was birthed with the idea of basically creating kind of a future of real estate where individuals can invest in real estate the same way institutions or high net worth investors can. Before Fundrise, large real estate was only available to large investors.
So yeah, you have experience obviously on the large institutional side of things, and I'm curious, what sort of advantages do institutional investors like private equity or these developers that you're working with have that retail investors like myself don't have?
I think there's two. One is just the type of products you can buy. So if you thought that skyscrapers were a great investment, right? Only institutional investors can do that. So there's certain types of asset classes like data centers that basically are only institutional investors. And the separate is just the type of financing you can get, the type of operations, there's a lot of economies of scale. So from an operations point of view, operating, let's say we own 20,000 apartment and residential units. That's very different than owning like 3.
So Ben, when I was looking at your guys' fees and structure, because you guys are large and you're deploying out so much and buying, is that how you guys can control your fees so much throughout? But because you're just doing the bigger skyscraper deals, the larger deployed capital, is that how you guys are so competitive and what you charge?
I think it's a combination of things. We definitely operate at scale, and that's like something that we are now. In the beginning, we had to grow into that. And in the beginning, we basically was just subsidized by our investors, right? So we had lower fees and we were losing money in order to basically get to scale. So our fees are super low. I mean, much lower than like other institutional. Like if you were comparing us to like Blackstone or Starwood, their fees are like 5-10 times higher.
Is that your typical competitor on a deal, like Blackstone or one of the bigger institutions?
Yeah, on the buy side, when we're buying apartment buildings, like we saw Carlisle a lot. Yeah, those types of institutions were not so much Blackstone. Blackstone buys platforms, but so other private equity funds.
For those in our audience who aren't really familiar with the traditional real estate private equity business model like Blackstone or some of the people you used to work for, can you just explain sort of how they make money, what their objective is, just in a general sense, how this sort of market of raising money for private investors to buy large-scale real estate works?
Yeah, well, I love that question. So there's actually, I put a lot of thought into that because you sort of, to understand how to disrupt an industry, you got to understand how it works. So there's a really value chain in the industry. So you start with large pools of money, typically pension funds. So maybe like California state teachers, they run $200 billion. They have all these advisors, all this bureaucracy. They basically allocate money to private equity funds, or private equity funds raises money from these big pools. And then private equity funds turn around and invest it with real estate companies in local markets. So there might be like a local developer in Seattle who knows all about office or apartments in Seattle, and that private equity fund will back them in a sort of a 90-10 deal, 90% from the private equity fund, 10% from the local sponsor. And so it's really like the whole industry is made up of sort of 3 major players: the funds that allocate the money, the real estate operator who runs the deal, and then the actual like large pools of capital, like the Norwegian Sovereign Wealth Fund, for example, $1 trillion. Like they have to put that money to work. So it's actually really a lot of it's about getting those flows into real estate.
And what are the, what are the sort of benefits that either an individual investor like myself or James, or someone as large as the Norwegian Sovereign Wealth Fund, why would they choose to allocate funds into real estate private equity when they have, every option in the world for where to invest their capital?
Yeah. Well, I mean, okay, so these large institutions will allocate their money everywhere. So they typically diversify across every single asset class. And so real estate typically gets about 10% of all their assets. And it's really about diversification. So that's how these big institutions think first. They first diversification. And then once they get diversification, they go inside of like a subsector like real estate, or maybe it's venture capital, right? And say, okay, I'm going to allocate X percentage to this sort of asset class. And inside that asset class, I'm going to find experts who are best at investing in real estate or infrastructure or like green power, whatever the asset might be. And so it's like a very special problem having to invest like $100 billion. It's like hard for most people to imagine. How is that a problem, right? But it doesn't sound like a problem. But when you get into it, like, they want to, typically private equity is achieving like pretty good returns. It's usually beating the stock market for the last like 30, 40 years. And so that's why they invest in it, right? Because there's been historically better outcomes than public stocks.
So on Bigger Pockets, there's a lot of like active and passive approaches to how people want to invest in real estate. And, obviously on Bigger Pockets, there's a lot of new investors or, people like me that we're trying to grow our portfolios and we're very active. But it requires a ton of work on our side. I know I was at my office till midnight the last 3 nights, just getting my hands dirty, getting things done.
My kind of guy.
Yeah, it's I will put in the hours, but it does have some wear, right? And a lot of investors are more passive, where they don't want to stay at the office till midnight worrying about their construction budget or crunching numbers and getting that next deal done. Is your typical client mix more of a passive, larger fund, or like these bigger institution, or do you have a lot of smaller investors too that just are, like for me, like after a certain amount of years, I will be sick of keeping my hands on everything and I just want to put the money out, right? But we're just trying to build that huge lump
No,
sum.
you won't, James. You're addicted.
Probably not. I am a true deal junkie, but
you keep telling yourself that.
That's the theory, right? The whole financial freedom I'm chasing. Is there people like who's your typical client that goes? Is it larger funds or is it smaller investors also looking for that passive income?
Yeah, so we have 350,000 active investors. So we have like a huge number of people. And so that basically, it's hard to describe any like one persona. There's like all different kinds of people. There's like a lot of software engineers who want to invest in real estate. There are a lot of financial professionals. Like I go in to meet investment banks. I was meeting with some investment bank like before COVID. I was sitting in the room and there's like, their investment banking group and had the real estate group and it had their tech group. And the older, like 60-year-old managing partner was trying to ask me about Fundrise. And I was like, well, who in this room are like investors in Fundrise? Everybody under the age of 40 raised their hand. So like half the room was actually my investor. So it's like a lot of different kinds of people. But I find the thing about real estate, there are new real estate investors who are interested in learning. They want to get their feet wet. Maybe they want to like take a small amount of capital risk. So maybe they'll invest 1,000 or, they don't want to go put $50,000 into one deal. But you know who loves to invest in real estate? Real estate people. So I have all these big real estate people who also like to say, well, I have my real estate where I'm active, but I have also other real estate I invest in. Sometimes I invest in Fundrise. Sometimes I help other people in the industry that are rising stars. So it's so diverse, and it's one of the interesting challenges because we have this range of people who want like tons of information and are really sophisticated, and people who, don't know what a cap rate is.
That's a really good point. We talk about on the show a lot about diversification. I think a lot of people assume that means diversification between different asset classes like the stock market, bonds. But I at least, I think James is a living example of diversification between real estate assets, right? Like being able to buy single families and short-term rentals. And so it sounds like a good portion of the people who are investing in these passive deals might also have an active portfolio and are just trying to balance how they're spending, not just their capital, but their time, right? There's probably, people don't have unlimited time to go acquire deals at the rate James does.
Yeah, it's actually the easiest people for me to talk to is a real estate person, and they get comfortable with investing in things they know. So a real estate person can underwrite real estate, like, oh, I get this. But if I were to bring you like machine learning, right? If you want to invest in machine learning, like you say, I don't know. I don't have no idea how to make that decision. So a lot of times people invest in things they understand. And so a real estate person would start with us and say, oh, actually, you guys really have like a deep sophistication here. Like I'm interested, and they might want to invest in like a geography they're not active in, right? Or product type, as you said, like they're an office guy and they want to go invest in residential.
One of the things I invest passively, primarily at this point, and one of the things I like most about it is being able to get into geographies that I'm not in currently. What markets are you heavily invested in? Like, are you geographically, are you flooding the Sun Belt just like a lot of people are on this show, or
Like everybody else.
Yeah, exactly. I mean, you don't have to give away your trade secrets, but are there any geographies you're particularly interested in?
Yeah, it's funny. So Fundrise has been around since, as I said, after the financial crisis, and we were all in on urban infill in like 2012 and 13, 14. Anybody who was in real estate knows that like the sort of emerging neighborhood was where everybody was investing. And then 2016, we pivoted and started really investing in the Sun Belt and selling all this stuff in like Brooklyn and DC. And so we went like heavy Sun Belt, like our 20,000 residential units are all Sun Belt. And so now it's still, I still think Sun Belt's where it's at. It's just, I think it's all about built for rent rather than multifamily. I mean, I think both are good, but I still think Sun Belt's got the runway. I still think that like an Austin or a Nashville will just keep on building. The only place I'm interested in now is new. Is I really think Columbus is interesting. I think Columbus could be. I mean, I'm not interested to go to. No, sorry, not. I work with somebody from Columbus. I always like to tool on Columbus, but yeah, I think Columbus has got like huge amount of growth coming. That's like really going to be interesting because of the Intel chip plant they're going to build there.
Oh, okay. I've been to Columbus once. It was pretty fun. I had a good time.
Hey Ben, how often do you guys analyze that strategy and like look at pivoting? Like, because I mean, at some point you made a pivot in 2016. Do you guys audit that once a year for your strategy, and then, or like how far down the road are you forecasting when you're looking at making that? That's a big change, right? Going from that's a totally different type of market, emerging cities to Sunbelt. Like, how often do you guys do that and forecast?
Yeah, I mean, back then we did it because we were investing across the country, but mostly in the urban infill, and we were learning from doing deals. One of the things you do is if you invest in a deal, let's say in a new market, you learn a lot, and if it's going well, then you can actually double down. And so we were invested in a few emerging markets, like which at the time, like I remember actually I had a person used to work for me, and they were like, "You got to sell everything in Florida." Because the next recession, like Florida's going to get killed and New York's going to basically do great. Because that's what happened to every other financial crisis, going like 2008, 2001. You know, the sort of Sun Belt got killed, and this was like totally upside down from how it normally happens. So, like if you like an intuitive answer and an analytical answer, analytically we have 100 software engineers. So we've been building software into our system, so we actually start getting real-time data from all of our properties, and also, I don't know, like 14 million other properties, some huge number. So we can really see what's happening on the ground and have a good sense of like where growth is and essentially where rent growth is and occupancy, delinquency. So that's a huge part of it. And the other part of it's kind of what I'd call is top down. It's really easy to see that like when something's getting really expensive, like if you're in New York and there was a 2.5 cap back in 2017, and people assumed rent growth had to go to like $8 a square foot, you're like, they just don't believe that, right? So at some point, the Sun Belt will get too expensive relative to the, gateway cities, to New York and LA, and that's when it's over. Like that's when it's like topped. And so it's really a question of like, you do bottom up analysis, like in the weeds, and you do top down analysis, looking at the big picture. You have to do both.
How do you make decisions about that? Do you have like an investment committee, or I guess I would say, I hope you're not just making algorithmic decisions like Zillow was doing and failing at for a while.
Yeah, right. So, Fundrise is 325 people, and so we have like a lot of real estate people, and we're in a lot of markets. So it's driven by the people first. The software just makes it easier to see the information. But the idea that software is going to replace people in investment decisions, I think that's a big mistake. That's not where our software will make improvements. Our software can make improvements on the operations. It's really the operations where the software can improve basically like all the work that's done after you buy it. But whether or not you buy it is a human decision.
So you use the software to increase the return, but not analyze the return.
Yeah, and manage it. There's like we have like we actually intend to roll the software out to third parties probably like in about a year, because there's actually nothing really like it out there. But we built it for ourselves, and we know it's good. We know it works, and so we'll make it available to more people. But it's like it's going to take time. We just don't have the bandwidth.
You said something earlier, Ben, about build to rent and liking it better than multifamily. We just did a show with the National, God, I'm going to butcher this. It was a Multifamily Housing Council. And they were talking about just huge demand for multifamily units. And that, I think, bodes well for the future of multifamily. But I'm curious if you have a different take. Like, what do you like about build for rent as a asset class going into the future?
So we got into that build for rent around 2019. We've been trying to get into single family housing since 2017. We couldn't find a way to do it at scale where it was efficient. And the reason we went into it was we saw our office is made up of mostly millennials, and the millennials are turning 30, having kids, leaving cities. They need more space and a house. They wanted a house. And the second thing that happened that we didn't expect was work from home. And work from home, I think, is like a biggest social revolution happening. Like, it's like, if you go back 100 years, people used to work on farms, right? They moved to cities to work in factories and office buildings. Like, now they're leaving cities and they're leaving office buildings. It's like that big a social change. And so work from home, I think, is like going to drive residential value. It's going to take $1 trillion out of office and put it into residential value. And so if you're going to work from home and you have kids, are you going to do it from a 1-bedroom apartment downtown, or are you going to do it from a house? So I think the house is a better consumer product. It has a backyard, it has light, it's actually cheaper per square foot. And you're willing to basically commute because you don't have to commute as often anymore because you're working from home. So basically, like it's like an iPhone is a better product than a BlackBerry, right? Like the home is a better product than the apartment. And so we said we wanted to invest in that, but we didn't want to go buy single family homes because basically that would put us in competition with our customer. Our customer wants to buy a home, and they don't want to compete with $1 billion institution to buy it. So we said, okay, well, we can't compete with our customer. Well, let's build it. If we build it from scratch, we can build it like designed to be this new thing. So it's like an apartment building laid down on its side. It's got amenities like a swimming pool and a clubhouse and all the things you would have in like a really cool apartment building, but instead in a 100-unit community where you have dog park, running trails, all these cool neighborhood features, and we run everything, right? You don't have to deal with lawn care, you don't have to deal with maintenance. So it's like a really cool product, and I think it's just going to become a big part of the industry.
Did the build for rent have anything to do with implementing the plan too and efficiencies? Because like we build 50 homes a year in Seattle, we renovate about 100 homes a year. And I can say renovating is substantially less systematic than building. Like building, you go through the plans permit, you're hiring professionals, it's managed all the way through, and you can actually control it a little better. Whereas remodel, every house is so different. Does it have anything to do with that and keeping your deferred maintenance down? Because I know like on our new build apartment buildings or rentals, we have way less deferred maintenance and way less issues, because the remodel, there's always those trades that do things a little bit different, a little bit wrong, and then you have to come back and fix those things. Does that have any impact in making that decision, remodel versus, or was it all about who your consumer was and what they were trying to do?
Yeah, totally. So more than most people about this. So we started out in the remodel. We bought about 50 homes in like LA, and it was a nightmare. So it was just hard. Every home was different. The permitting was just horrible. Like we constantly had squatters breaking in. It was just like, it just didn't scale. It's just, we couldn't pull it off. And we were like, okay, well, we still think this is a huge macro trend. And so we went to home builders. We also bought land and said, oh, this is zoned for 400 suburban apartments. Let's build 200 single family homes instead. And so we went to a home builder and said, hey, we want to build 200 single family homes here. And they're like, oh, interesting. You want to buy homes? Like, we build a lot of homes. And we found that the home builders can build homes for way cheaper because they build 10,000 homes a year. So they can build homes way cheaper than even like if I sat down with a development company and did it, like we might build for $200 a square foot and they'll build for $150 a square foot. So we partnered with home builders, and those home builders basically build us. We've built 5,000 homes so far. And we really built a lot, and we intend to build more. And so it's the home builder at scale can deliver basically a bespoke product, with that's designed right for long-term ownership, rather than as you said, the renovations, which are mostly make the renovation and sell the house before the deferred maintenance comes home to roost.
That these types of the type of development you're describing sort of reminds me of some of these planned communities that honestly I'm more used to seeing older people, retirees kind of live in. Are you appealing to the work from home demographic and younger families? You were talking about the impetus for this being millennials buying homes. Is that who you're building the product for?
Well, that's what we thought we were building it for. It turns out it's everybody.
Oh, okay.
It's so diverse. Here, I'll give you here's one interesting stat. A typical apartment building, 25 to 30% of people have a dog. And in build for rent, 70% of people have a dog.
Whoa.
Right? Because you have a backyard, right?
Yeah.
So guess what? People who have dogs want to live in a house rather than an apartment. So there's all sorts of drivers for why you want to live in a home with a backyard and more light. And so when we compete on apartments.com for renters, you're selling basically a different experience. And I think for a lot of people, they didn't even really know that was available. The idea of renting a home that's not from some kind of random mom and pop who's not going to have that good of a property management capability. So it's a new asset class. Real estate, if you go back 20 years or longer, as long as I've seen, right? Real estate actually births new asset classes every decade. So 20 years ago, there were 0 data centers, right? Now data centers are a huge part of the REIT business. 20 years ago, right, there was cold storage wasn't a thing. Self-storage wasn't a thing. Cell tower REITs weren't a thing. Single family rental, as an asset class, got birthed by Blackstone with Invitation Homes. So these new trends show up, and the old trends like retail and office die. So it's key part of real estate is being part of the new trends.
That's very interesting. James, I'm curious, would you ever build for rent at your scale, or does this only work at scale like Ben is talking about?
I think it works more for large short plats, because the larger the plat, the cheaper it gets. It's kind of like when you build a home. If you build a 4,000 square foot home versus a 2,000 square foot home, your price per square foot is going to be a lot cheaper on the large because your core areas are still the same. But when you have these big plats, they can really cut the cost down. So we build infill. We built, our largest site's probably 12 units, 12 townhomes. We do all townhomes, mostly 4 to 12 unit sites because that's what you get in infill. Our build cost around Seattle is about $275 a foot from development to finish, and it's getting you a higher end product too. But if we look at our track home, my clients that are track homes that are buying more 100 plat sites, they're building in the low 200s, and so it makes a huge difference in your bottom line when you can get scalability. Plus, you get the efficiencies out of the renting, the property management, the maintenance, everything's in one central location. And so, yeah, the larger the plat, the cheaper it's going to be. And the other good thing about the building to rent on these large plats is the typical time for purchasing these is a close on permit. When you're negotiating a lot of these deals, you get a close with the permits, and it could be a year or two down the road, but you can get building day one. Whereas in infill on the smaller stuff, it's such a hot market that sometimes we have to close half the time that we would need for the permits. And so you can systemize out the bigger plats just substantially better. But the downside is you got to have Fundrise money. You can't go buy it with, like I'm not going to go buy I'm not going to go buy 100-unit plat, because I'm going to be putting everything into one pot. And so the bigger the money, the bigger the scale.
Yeah, that's exactly what we found, because we have a mentality. We hate to outsource anything. We always do try to do things ourselves. And we started out trying to build these things with our own capabilities, and the home builders just crushing our execution, right? So they're building at $150 a square foot. Like, we couldn't build for less than 200 a square foot, and they're building for 150. We're literally buying homes right now in Austin, like above Pflugerville, for 130 a square foot. They just have such scale, and they buy like 10,000 countertops, right? They just have such control over their supply chain. It's, now that I understand that business, it's really a factory. It looks like a real estate company, but it's actually a factory, and everything is about how something moves through the factory floor. Like the plumber is coming exactly on time. Like if you've done renovations at home, where in a one project, like there'll be this massive downtime between when the electrician was supposed to come and when the guy is supposed to close it up with drywall, and he won't come, it'll be delayed. You can't actually close up the wall because the electrician hasn't shown up. And so it's all about coordinating the trades, and you can do that with a home builder in a way that you just can't do that as like even 100 homes. It's not like scale.
Yeah, it's kind of like the whole premise of like the Toyota manufacturing plan, where they build the cars that are constantly moving. You just get so much, or Boeing, same thing,
right?
Where you get so much more inefficient. Because your labor guys go, here's my house, I got to walk next door. Here's my next house. Whereas with remodels, you got to drive an hour down the road, and you don't know exactly when it's happening.
Right. So like a lot of times people ask me about cap rates and stuff, and we buy on basis. Like if we can get a C of O for $150 a square foot in Tampa, like I'm feeling pretty good about that. And exactly what cap rate it'll end up like leasing up to is cap rates come and go. I mean, like when I started the industry, like you'd be like, okay, shouldn't we build to a 12? And I was like, what, a 12? Like now people are building to a 5, maybe 4, maybe a 6, but like, so cap rates will come and go, but your basis is forever.
So it seems like, I mean, just for people listening to this, it sounds like there's not really a good way for like a retail investor to go out and get into this asset class of buy to rent. With the exception of Fundrise, I guess, they could get in it. Or are there other ways that people can like hop on the build to rent bandwagon?
I mean, it's really new. It's a new space. I mean, like seriously, there are probably 50,000 units across the country. I think there's like 50 million apartments. I mean, this is really new. Like when I'm talking institutions, because they want to do it too. They can come in and like co-invest with our customer. Like I love the idea of like a multi-billion-dollar institution investing next to a $10 investor. Like that doesn't happen in normal life. But the platform we built basically is a platform that they want.
And what kind of investor, for the smaller investors, they have to be accredited to invest in your...
No.
Okay.
Anybody can invest. Yeah.
Oh, cool. So how's that work? Because like normally on a syndication, you have to be accredited. There's like a minimum of like, I don't know, usually 50 or 100 grand. How do you get around that?
By going through it. So our vehicles are publicly registered. So we actually go to the SEC, say we're going to have a strategy to invest in build for rent, and we're going to basically like allow the public to invest in it. They work us over like the no end, and then we get it cleared. And so that's why anybody can invest in it.
Oh, so basically the reason you have to be accredited for a syndication normally is, correct me if I'm wrong, Brad, is because they're unregistered securities, right? Like it
Right.
is not vetted by any government entity, like stocks, for example, which are regulated by the SEC. And so you're saying you register your investments with, is it the SEC or is it different?
Yes, the SEC. Yeah.
Is the SEC? Wow. Are you the only people who do that?
I mean, it's
You don't have to tell me your trade secrets.
no. I don't want to say categorically there aren't people who are doing it, but I mean, yeah, we're the idea of going direct to consumer, registering the funds. I mean, like again, that's a scale thing, right? Like you're not going to do it for a 50-person syndication, but if with 350,000 investors, right, it's worth the cost to do it is significant, right? I mean, we have we have 50 accountants in house, right? Like it's a lot of we have 5 in-house attorneys. Like there's a lot of grind on it, but across enough people, the marginal cost is like almost nothing.
Yeah, because they look under your hood a lot more at that point, right? The SEC. I mean, the big difference is
You're feeling violated, Ben.
but that's why so many people set up these syndications with unregistered securities, because I mean, to Ben's credit, that's a lot of work, and it's not worth the headache if you're doing a 50-unit apartment building, because it's the cost and the audits and the qualifying is pretty good. But that means that your investor can feel pretty good about putting money with you, though, because it's getting an extra pair of eyes and audit compared to a lot of other syndicating platforms.
Yeah. I mean, we've been doing it for a while, and our CFO, my CFO, was chief accountant at the SEC. So we have expertise. We kind of know after a while, you kind of know what you're doing. And just like anything, I'm sure with real estate, when you first started, you talked about doing an 80-unit apartment building before we started this show. When you started, you were like, how would I do that? Right? I wouldn't know how to do that. But once you know how to do it, right, it's not that complicated. It's just knowledge. And so, working with the regulators, understanding what they care about, giving them what they need, is once you understand it, right? It's not rocket science.
I can't imagine what the SEC would do if they looked at my personal real estate investing and the way I've kept my books over the last 12 years. I'd probably be in jail. Not that I'm doing anything illegal. I'm just a little disorganized, okay?
I have to edit this part out. Hey, Ben, have you guys had any problems with inflation and supply chain issues in this build to rent? Because, obviously that's been tough for us as builders, controlling our cost. Actually, randomly, it's been easier for us to control our cost more as a builder than a remodeler. Mm-hmm. The remodeler has been tougher because I think the labor market's less experienced, and so they charge more. But what's inflation been doing to that your returns if the build cost goes up, or how do you mitigate that, or how do you deal with inflation?
Yeah, there's a lot of complexity in what you're asking. So let me just pick a few things because, yeah, he had a huge effect on everything. I mean, everything was going crazy last year, especially. So so I'll just give you so the reason we broke through with Build for Rent is we went to these home builders in 2019 and we were talking to them and they were maybe interested, but mostly they weren't interested. Then March 2020 happened. If you remember March 2020 when the stock market collapsed 40% and people were locked down, guess what people were not doing in March 2020? Buying homes.
Except for me.
Yeah, most people were not. So the home builders had all these homes and all of a sudden the industry just stopped on a dime. And they turned around to us and said, do you want to buy these homes? And we said, yes. And so we went under contract for $500 million of homes that summer.
That was a good month.
Yes, because then they had to deliver them. We go under contract and they deliver. Home builders, we go under contract and they deliver them over the next. It took them 18 months to deliver all those homes, and so our contract price was scorchy, and they would come back and they would be like, "I know, I know we're under contract, but every single cost is going up. Can we talk about this?" And so we had a lot of complexity there, and then they deliver. We're talking about delivering 100 homes a week. We were buying a lot of homes, and they deliver them without refrigerators, without a kitchen. We'd go in for the inspection and be missing a kitchen. They would just not be able to get certain things. In Texas, we couldn't get door hinges. They would deliver the home, and be we put these hinges on, but you knew the hinges opened out. And so you can't have hinges open out because then somebody can walk up and just unscrew the hinges and take the door off the house. So like there was just all these little things that they had these problems around. We had a person driving around buying refrigerators at Costco so we could actually like rent the houses because we had these houses without refrigerators. So yeah, there was all sorts of chaos happening.
Talk about when they say timing is everything. That's the best time. So you bought it cheap, and then so the build costs were locked in too. When you committed to that?
Yeah.
That hurts.
Yeah. There was one deal we were under contract with, and the builder had a $5 million liquidation. Like they had to break the contract with us. They had to pay us $5 million, and they literally just like broke the contract.
Whoa.
Yeah. We're just breaking this contract.
It was that bad. Oh my God.
It was that bad. It was in Austin, and they're like the price of the homes had inflated so much. They're just like, we're just walking away from this contract. Forget about it.
Wow, that's insane. Are you starting to see that level off now, or are things getting better in terms of supply?
Oh, yeah. Well, supply chain's still a little messed up, but the home building industry is now flipped again, and like sales are falling. And I'm like, oh, I've seen this movie before. Like, So, but this time, like last time, there was nobody doing this. Now there's more money now, like chasing build for rent. So we're not the only sort of buyer in the space. But yeah, as you know, the market's shifting like a lot right now. There's a lot changing.
I know you don't have a crystal ball, but like where do you see things going over the next year or so?
Yeah, I mean, in some ways, the next year is easier than the following. Like we've been saying since January that interest rates are going to be higher for longer. And like Powell last week, at the Jackson Hole meeting said 4% Fed funds rate for all of 2023. So that means basically you're borrowing at 6% or more, where you used to borrow at 3%. Or at least that's what we were borrowing. So, so I think the industry is going to grind to a halt. Like I think most things don't pencil at more than 4% interest rates. I mean, base interest rates, like the Fed funds rate. So, and I think that like the surprise is going to be, our expectations, the surprise are going to be that inflation doesn't come down as much as people expect. Interest rates stay higher for longer. And it's like, almost like people are like, well, how can that happen? That's so bad. And it's like, because it doesn't care how you feel about it.
Sorry, but that's the truth.
Well, and it's also history repeats itself. That happened in the 70s, right? Like it just kind of stuck, and then it had to get it worked through the economy and on to the next thing.
Yeah, I mean, I don't know what you're seeing, but like, we have 300 people, like wages. It's super competitive for labor, like food, everything. I'm not seeing inflation come down like in any meaningful way. So like, why do I think it's going to all of a sudden, just shift? It just doesn't seem likely to me. So like the thing we did, we really slowed down investing back in January, and we started building up cash. So we have like $700 million of dry powder right now. So we were ready and kind of fairly ready for the shift. And then the shift's going to be, you need to go into invest in credit. That's the credit markets. That's another learning, because I've been in this for a while. In the financial crisis, all the action happens in the liquid credit markets. Like in 2020 or 2008, right? You couldn't really buy properties, but you could buy the paper. And so the paper is where like the pricing shifts a lot faster, and you can get way more distress. But that's like a whole different part of the real estate industry that most like people don't see. CMBS, RMBS, asset-backed securities, that kind of stuff.
Oh yeah, because they'll dump that paper cheap. I remember one of the best deals I ever did in 2009. I didn't even know how good of a deal it was when we did it. Someone came to us. They had a 10-unit in foreclosure, and it was like a private lender. And they're like, hey, we want out of this. They sold it to us for 50 cents on the dollar. Mm-hmm. And then we were running it like, oh, okay, cool. We're going to be able to buy this. We'll foreclose it. No one wants it. It ended up getting bid up. We bought it a week before the auction. We bought the paper. We took it down the auction steps. We foreclosed it. Mm-hmm. And then it got bid up. They were step bidding against us because we wanted to keep the building. We had no intentions of selling it. And we made like a 300% return on our investment in 10 days because someone really wanted it. And I was like, and we had no intentions of selling it, but we're like, that was the easiest thing. We didn't have to touch it. We didn't have to do anything. The guy gave it away. We got it escrowed, and it was just a win all the way around. It's amazing what that can do.
Yeah. So like, we're all in like the real estate business, but there's like this shadow real estate industry that you don't know about, where all of the things you do where you borrow money, right? You buy an apartment building, you buy a house, like eventually like most of that asset's actually financed. And then there's this whole parallel real estate world of like credit markets where people are buying, your paper and levering it up too, right? So so there's actually like when you buy a house, you buy an apartment building, you're borrowing maybe 75%. And somebody behind the scenes has bought that paper and levered it up 10 times as well. And then somebody bought their paper and levered it up 10 times more. And so like the shadow industry of like, trillions of real estate, just the debt is like, it's become much more attractive than the equity.
That's super interesting. Yeah, I actually was just looking, last week at investing into a note fund. It seems like a really good place to be investing right now. Ben, I know we only have you for a couple more minutes, so maybe we'll have to bring you back to talk about note investing and the credit markets. That would be super interesting. But before we go, can you just tell our audience about where, obviously they can find you on fundrise.com, but if anyone wants to connect with you, what's the best place that they can do that?
Well, I am active on Twitter, so my Twitter handle is Ben Miller Eyes, like Rise, benmillereyes. And so you can hit me up there, LinkedIn, contact at fundrise.com. Like anytime anybody emails me at the main email address, I always get it. So I'm always interested in hearing people. You learn a lot. Our actual investor base constantly communicating with us, and we're always learning about really interesting things. We basically have people everywhere at this point, and they're really like generous with sharing information. So I love to hear from people.
Awesome. Great. Well, Ben, thank you so much for being here. This was a lot of fun and learned a lot. And we'll have to have you back on the show sometime soon.
Great. Excellent.
It was good being you, Ben.
That was a lot of fun. James, what did you think about the conversation with Ben?
It made me realize how small I am as an investor still. It's...
oh, dude, don't even start.
But you know what? I don't get to talk to these big institutional guys that often. And the only time I really get to talk to them is when I get notified their offer's way higher than mine. And so it was nice to kind of talk to them and figure out. But it's very interesting, like how they are moving things around, looking at things, and it has the same core principles as us, like be efficient, buy the right deal, don't let your procedures kind of maximize yourself out. So the core principles were the same. I think the money is different is what I realized.
Dude, you talking to Fundrise and feeling small is how I feel every time I talk to you. So now you know what it actually feels like. Yeah, man, I thought it was super interesting. Like, I'm really kind of just fascinated, like from an economic standpoint, about build to rent. Like he was saying, it's like this whole new asset class that just never existed before. Like previously, you either built multifamily to rent, or you would like reuse single family homes that were previously owner occupied into build to rent. And so it's a really interesting phenomenon, and you read a lot about it. But to his point, he said there's only like 50,000 units. So it's really not like taking over the market. But that's something I'm definitely going to be watching for the next couple of years to see if that makes an impact on the markets they're doing it in.
I think if we go into like a little stall too, and dirt gets a lot cheap, the reason they're not doing build to rent is dirt's expensive and build's expensive. But both those are coming down right now. So maybe that hits a sweet spot and they start doing more and more of it.
Yeah, that'll be interesting. For everyone listening, before we record, usually the guests and us just, talk for a couple minutes to get to know each other. And James was telling Ben and I about this 81 unit deal he just did. And Ben was like completely amazed at what a good deal you got. Can you just tell us quickly about this deal and how you landed it? Because I'm very curious.
Yeah, it was just so we've been looking, we do small syndications or, 30 to 40 units in Seattle. And then we've been trying to get into 50 to 100 because like what he was talking about, the efficiencies of remodeling, property management, it really does make a big difference in your bottom line. And recently what we've noticed is those deals are now, they were trading at like a 3.5 cap because of guys like Fundrise coming in and buying them all. And that has slowed down. And so actually it was a seller that we gave an offer to at 11.8 million about 6 months ago, and he turned it down. He went to market, found his new exchange, got tied up twice at 11.8. Or no, he went all the way up to 12 million at the time. Financing blew up both times. And we kept, well, actually our 11.8 number dropped to 10.8 because the rates and the cost of the deal. And so we just stayed consistent with him the whole time for 6 months. And we kept updating our offer to saying, hey, based on rate, here's our new number. And we always had that logic of our number has changed only because of the rate with this guy, because he's a bigger seller. And we ended up locking it in, though. 81 units. It's about 10.9 million. We have to put about 25 grand, 30 grand into each unit. We're going to be doing a soft cosmetic with windows, hitting siding, hitting roofs, but nothing too crazy. Mechanicals are good, and we're excited because we have some more opportunity now. But that's the key right now, is just stay with your numbers. And then if you have to change your numbers, just educate the people why you're changing them so they don't think that you're just trying to take one over on them. And it all came together. But I was happy to see that it looked like I blew the return socks off him.
Yeah, yours. Ben asked James what cap rate he sold at or bought at. He said 5.8, which is just like kind of unheard of, especially in Seattle, right? You said like a couple years ago it was 3.3 or something like that.
It was like, yeah, they were down in the low threes. Now, granted, the 5.8 is after stabilization.
Okay.
So after we've done the hard work, we'll be at a 5.8 to 6 right in there. So it wasn't on existing.
So that's where you're underwriting it at. Yeah.
Yeah, stabilized, we're 5.8.
But still, pretty damn good.
You know what? And I think we could do better.
You're insatiable. You got to do better.
Gotta do better.
All right, great. Well, great job today, James. As always asking good questions and telling really very relevant and funny stories about your own experience. So thanks for joining us. Everyone out there, thanks for listening, and we'll see you guys next time for On the Market. On the Market is created by me, Dave Meyer, and Kaylin Bennett. Produced by Kaylin Bennett. Editing by Joel Esparza and Onyx Media. Copywriting by Nate Weintraub. And a very special thanks to the entire BiggerPockets team. The content on the show On the Market are opinions only. All listeners should independently verify data points, opinions, and investment strategies.